Hi everybody. In this video we'll talk about sales returns. Customers are frequently given the right to return merchandise they purchase, or sometimes a customer might be given a special price reduction as an incentive to keep the merchandise they want to return. We use the term sales returns to refer to these returns and price adjustments. Sales returns are common in several industries such as food products, publishing, and retailing. Sales returns are a form of variable consideration. Because products might be returned or prices might be adjusted, there is an uncertainty as to the final amount the seller will be entitled to receive. Recognizing returns only at the time they happen might cause revenue and profits to be overstated in one period and understated in another period. For example, assume merchandise is sold to a customer in $10,000 in December 2021, the last month in the selling company's fiscal year, and that the merchandise had a cost of $6,000. The company would recognize a profit of $4,000 in 2021. That's the $10,000 sales revenue minus the cost of goods sold of $6,000. If all of that merchandise was returned in 2022, after the financial statements for 2021 are issued, gross profit will be overstated in 2021 and understated in 2022 by $4,000. The 2021 balance sheet is also affected, with a refund liability understated by $10,000 and inventory understated by $6,000. So how do we account for sales returns? During 2021, its first year of operations, Hawthorne Manufacturing Company sold merchandise for $2 million cash. This merchandise cost Hawthorne $1,200,000. In other words, the cost of goods sold is 60% of the selling price. Industry experience indicates that 10% of all sales will be returned, which equals $200,000. That's the $2 million in sales revenue times 10% in this case. Customers returned, actual returns during 2021 was $130,000 of sales. Hawthorne uses the perpetual inventory system. So the journal entries Hawthorne would make are cash, $2 million, sales revenue, $2 million, debit cost of goods sold, $1,200,000, credit inventory, $1,200,000. And when the sales returns of $130,000 occurred during 2021, the cost of returned inventory can be calculated at 60% of the sales amount, or $78,000, and the journal entry would be debit sales returns, credit cash, and debit merchandise inventory, credit cost of goods sold for $78,000. That's because we had a sales return. We have to reverse the sale, and we also have to put the inventory back on the shelf and reverse cost of goods sold. So at the end of 2021, an additional $70,000 of sales returns are expected. The cost of inventory on these expected returns is $42,000. That's 60% of the $70,000. And the way that $70,000 came about was we are given the fact that we estimate 10% of all sales will eventually be returned. That's $200,000. Only 130,000 of returns actually happened during 2021, leaving an additional $70,000 expected to happen, but they won't happen until 2022. So we're going to make an adjusting journal entry at the end of the year, debit sales returns, credit refund liability, which is a real liability on the balance sheet, debit inventory dash estimated returns. It's not on the shelf, so we can't debit the actual inventory account itself, but we're expecting to get it back. So debit an asset account called inventory dash estimated returns and credit cost of goods sold. And then let's say that we had a perfect estimate, and during the early part of 2022, sure enough, customers brought $70,000 of sales back to us, and we would then debit the refund liability of $70,000, credit cash for $70,000, and then debit the inventory, because we actually got that inventory back then early in 2022, just as we expected to happen, and credit inventory dash estimated returns for the $42,000. What happens if Hawthorne's estimate of future returns is wrong? In the last few slides, it turned out that their estimate of $70,000 of future returns was exactly right. That's exactly what happened in 2022. But what happens if Hawthorne's estimate is wrong? Such returns end up being more or less than the $70,000 estimated. Well, this is a change in accounting estimate, and as you remember from Chapter 6, a change in accounting estimate is a prospective adjustment. Hawthorne does not go back and revise prior year financial statements to reflect the new estimate. Instead, Hawthorne must adjust the accounts to reflect the change in estimated returns with any effect on income recognized in the period in which the adjustment is made. For example, suppose in our illustration that only $60,000 of the 2021 sales were returned in 2022 instead of $70,000 that Hawthorne had anticipated, and that Hawthorne estimates that no more returns will occur. In that case, the refund liability account still has a pre-adjustment balance of $10,000. Likewise, the inventory estimated return still has an adjusted balance of $6,000. So in 2022, Hawthorne would record its change in estimated returns of its 2021 sales. These adjustments remove the remaining 2021 balance from the refund liability and inventory-estimated returns accounts. They also increase net sales revenue by reducing sales returns and cost of goods sold in 2022, the period in which the change in estimate occurs. So in 2022, debit refund liability, credit sales returns, debit cost of goods sold, credit estimated inventory estimated returns, $6,000. Here's another concept check problem for you. Please pause your video and answer the following question. $5 stores, FDS, sells merchandise for cash. It began 2021 with a refund liability of $0. It made sales of $1 million during 2021, which cost FDS 60% or $600,000. FDS also estimates that 1% of all sales will be returned, and actual returns during 2021 is $8,000. When accruing its estimate for the remaining returns at the end of 2021, FDS would debit sales returns and credit the refund liability for how much? Please pause your video, do some calculations, choose your answer, and when you have your answer selected, come back, start the video again, and check your answer. Did you choose answer D, $2,000? If not, please pause your video and examine this analysis and calculation. Here's another one. FDS sells merchandise for cash. It began 2021 with a refund liability of 0, made $1 million in sales during 2021, which cost FDS 60% or $600,000. FDS estimates its 1% of all sales will be returned and experiences actual returns of $8,000 during 2021. So in the prior slide, we determined that an additional $2,000 of returns are expected in 2022. So when accruing its estimate of remaining returns at the end of 2021, FDS would debit inventory-estimated returns and credit cost of goods sold for how much? Please do your calculations, select your answer, then come back and check the video to see if your answer is correct. Did you choose $1,200? If not, please check this video and look at this analysis to see why you would not have chosen $1,200. $1,200 is the correct answer. The next number of slides begin an analysis of bad debt expense. Slides 34 through 48 talk about bad debt expense, and I've already posted a series of slides on accounting for bad debts. I borrowed those slides from my Accounting 301 class. They're on the in the module in Canvas for the Chapter 7 videos. So please review those 4 videos as your discussion for accounting for bad debts expense under the direct write-off and allowance method, etc. That's it for this video. When we come back, we'll begin a discussion of notes receivable.